otherwise tight spaces that we've all had for the last year or so under COVID. So that was the first bit of news we got this morning. And then we had two data points that came out in the morning. Excuse me. You got the Purchasing Managers Index, Services Purchasing Managers Index, and Supply Managers Services Index. We looked at manufacturing indexes that take into consideration changes in manufacturing in the economy. This is the services index, which looks at changes in the services industry. As you see here, I point out that this includes transportation, communication, financial services, business and personal services, computing, information technology, hotels and restaurants. So it's a pretty broad composite index, much like the manufacturing indexes. And what's most important here is that the index registered its sharpest pace of expansion since the data collection began in 2009. Thank you. So both the PMI services number and the ISM services number, which stands for Purchasing Managers Index and the Supply Managers Index, showed a very strong growth. And so the economic activity under these ISM service index showed growth for the 11th month in a row, all of which confirms the data that we've been looking at for the last number of sessions that show growth in the labor market, growth in manufacturing, growth in vehicle sales, and as we see here, a growth. Flo, can you mute that, please? Growth in home sales, and of course, we see growth in the services sector. Services make up about 65% of the economy. So it's a pretty key driver for labor here in the US. And so therefore, that was pretty positive data coming out this morning. If we could, I'd like to take a moment then to look at what the conclusion was following these positive data points. The headline was that the U.S. economy is heading into a summer with huge momentum thanks to government stimulus and falling coronavirus cases. Can anybody tell us what happened in the afternoon with a federal judge with regard to eviction moratoriums? This afternoon, a federal judge vacated the nationwide eviction moratorium that's been in place for renters as a result of the coronavirus pandemic. We're talking about 10 million renters across the country that owe roughly $57 billion in past rent and late fees. And so with the suspension of the moratorium, what looks to be right around the corner, an eviction crisis, and that's going to be a challenge for the Biden administration to address, and we'll certainly take a look at that over the course of the next number of sessions. I'd like to look at yesterday's market performance.
Professor?
Yeah.
Just a really quick question. So obviously the government suspended rent payments for people during the COVID pandemic. Why would the government not suspend mortgage payments or tax payments on the houses that they're renting from?
It's a good question.
It makes no sense.
There isn't a readily available, reasonable answer. There isn't. And one of the things that we're seeing across the country are small landlords that are suffering and going into bankruptcy because they can't make those payments, because even though the renters have been afforded the privilege of suspending their payments, as you point out, the homeowners are not given the same privilege. And so we're seeing a wave of bankruptcies among small homeowners across the country. In other words, homeowners that have rental properties. And so, yeah, it's an absolutely valid question. What this action today does, it doesn't supersede state mandates. For example, in New York, where there is an eviction moratorium in place, and that takes precedent over the federal suspension, the federal suspension of the moratorium. But for a state like Florida and many others, where the only protection was granted by the federal moratorium, that disappears overnight. And so, like I said, like we know, there are millions and millions of people who fall into this category and who could be facing immediate eviction. And therefore, that's going to be a challenge that has to be addressed. Otherwise, we're going to see a grossly added to homeless crisis. Excuse me. So let's take a look at yesterday's market. Well, before we do that, let's look at on Wednesday, April 21st, we talked in here 2 weeks ago about how the Fed made clear and has made clear on multiple occasions that it's no rush to raise interest rates or allow inflation to rise well above its 2% target for a while without preemptively raising rates. And said on the 21st, it won't taper its asset buying until 2023. This is reiterated by a former White House economist. Last Wednesday, following a 2-day Fed meeting, we talked about in here the highlights of the meeting, and one of the highlights was Jerome Powell in his press conference reiterating, or rather responding to a question from a reporter exactly about tapering, again, that there's no tapering in sight and that doesn't even need to be contemplated at this time. Can anyone tell us what happened yesterday in the market with regard to tapering? Janet Yellen.
Oh, sorry.
Sorry, go ahead, please. Go ahead.
I said there were concerns over Janet Yellen saying that they might potentially have to raise interest rates to prevent the market from overheating.
That's exactly right, Jason. You've got that exactly right. In fact, yesterday Yellen suggested, well, she suggested in an interview that was published in The Atlantic, which is a very important publication, that Biden's plan to boost the economy may require some type of rate hikes at some point. What investors focused on was that statement, and that drove all of the indexes much lower for the day. Only the Dow finished about even, but the S&P and the tech-heavy NASDAQ were both meaningfully down, as her comments led to fears of Fed tapering, which put investors on edge. The fact is that what investors focused on was one part of the article. There's another part in the article where she goes on to talk about at length how she has no fear of inflation. However, if something was to unexpectedly happen, the Fed stands ready to address it with all of its various policy tools, which we've talked about. What I thought was interesting here was the correlation between comments that were made just a few weeks ago, comments that were made yesterday, and the effect on the markets. It only reinforces the idea that the markets are, to a certain extent, driven by fear, along with sentiment. There is a real concern now whether or not the Fed's going to be able to execute a soft landing. In other words, that the economy will be self-sustaining, in other words, without the need for extraordinary monetary support or fiscal support at some point, without suffering from inflation or some type of damaged labor market. So that's the big concern among market makers. And despite being reassured for weeks and weeks that there was no concern whatsoever about inflation or need to discuss tapering, even as recently as last Wednesday by the Fed chair himself, the markets got so spooked yesterday that the NASDAQ lost almost 2%. Anyway, I thought it was worthwhile to talk about. I know that there are some of you in class who follow these indices, and again, highlights the interconnectedness of the capital markets. Are there any comments or questions here before we move forward? Okay, so in our discussion the other day, we introduced the concept of swaps, where counterparties are able to exchange cash flows to effectively synthetically recreate their cash flows, to turn a fixed return into a floating return, to turn a floating payment into a fixed payment to suit their asset and liability objectives. And so yesterday we covered interest rate and commodity swaps. With interest rate swaps, we talked about swap pricing. We identified the LIBOR buyer, of course, the LIBOR sweller. The spread between the ask swap spread and the bid swap spread is what? Can someone tell us? What's the difference between what the LIBOR buyer pays and the LIBOR seller receives?
The wait, no, I'm not sure.
Pardon me?
I wasn't sure. My first thought was
price. It's the dealer price. It's the dealer price, the premium, more or less. Okay, it's what the dealer gets paid. We talked about quoting interest rate swaps. We identified the technique, which is interest rate swaps are priced off of the relevant treasury yield curve. And so we showed a 5-year treasury, the 5-year treasury trading at 270. The bid-ask quote was at 2024, which means that the LIBOR buyer is going to pay 294, which is the 270 plus the 24, and the LIBOR seller is going to receive the 270 plus 20, which is the 290. The 4 basis points in between is what the dealer gets on the notional principal amount. We did a review of interest rate swap strategies, which, as we pointed out, by far the most commonly used swap structure in the swaps universe. We said that if a company has, we said that if a company has fixed rate debt and interest rates are falling, well, they'd rather be paying a floating rate debt. So they want to enter into a pay floating, receive fixed. Otherwise, they're going to do nothing. If a company alternatively has floating rate debt and interest rates are going up, well, then of course, they'd rather pay a fixed rate because they'd rather have a lower cost. So they want to enter into a pay fixed, receive floating interest rate swap. In both cases, both companies are able to change the nature of their debt by entering into an interest rate swap that satisfies their risk objectives. Then we talked about floating and fixed rate assets. We said that if a company has a fixed rate asset that's earning a fixed rate asset and interest rates go up, well, it would rather receive a floating rate interest on its asset than a fixed rate interest. So it wants to enter into a pay fixed, receive floating interest rate swap. And finally, we said that if a company has a floating rate asset and interest rates fall, well, it would rather receive a fixed return as opposed to one that's going down, a floating return that's now going down as a result of falling rates. So it wants to enter into a pay floating, receive fixed interest rate swap. Are there any questions here? Okay, again, these are incredibly effective strategies to manage interest rate risk, which is omnipresent. And we're going to talk about some other techniques next week that allow companies to effectively buy call and put options on interest rates. Those are interest rate caps and floors, and we'll talk about those next week. So let's take a look at an example here. So here, the company A has a $100 million floating rate asset and fixed rate debt. It wants to hedge expected LIBOR changes. It wants to earn and pay a fixed rate. It's paying fixed. It wants to earn fixed. It can pay floating because it has a floating rate asset. So it enters into a pay floating, receive fixed interest rate swap, price at 1-year LIBOR. At the beginning of last month, a contract for a 2-year floating for fixed rate swap was written with a notional principal of 100 million. Company A agreed to pay every 3 months based on 1-year LIBOR. The counterparty, Company B, agreed to pay every 3 months or every quarter based on a 6.5% annual percentage rate. So no matter where LIBOR goes, Company A gets its 6.5%. So it's earning fixed and then is paying fixed. So its mismatched cash flows now are matched cash flows, and it will have effectively managed its assets and liabilities by bringing its debt and its assets into line. So the question is, if at the end of the first 3-month period, 1-year LIBOR is at 540, what are the expected cash flows? Well, we know the floating payment is going to be 1/4 of the 540. Why? Because you're taking 1/4, a quarterly version of the 1-year rate. So it's the relevant rate, 5.4, 1/4 of it multiplied by the principal, the notional of 100 million, is 1,350,000. In terms of the fixed payment, it's 1/4 of 615 multiplied by the notional. That gets us 1,537,500, which means that in the first period cash flow, the expected cash flow is the Company A would get it 187,500. Are there any questions here?
Professor, yes, I do have a question. The thing that
Sure,
I don't,
Nicole.
the thing that I don't understand, why is company company B like getting the fixed payment? Like it's
Well,
it gonna stay?
Company B is going to receive, Company B is going to make a payment. Company B is going to receive the floating payment. Company A is going to receive the fixed payment.
The fixed payment. Okay. Is it
Right.
gonna stay stated like that?
It
In a,
stays
like
like
in a
that. It stays like that for the entire term of the swap.
okay.
In other words, a swap is just a strip of forward contracts with exactly the same price but different settlement dates. So here the settlement dates are every quarter over a period of 2 years based
Yeah.
on a floating rate and a fixed rate. The floating rate is a 3-month version of 1-year LIBOR, and the fixed rate is a 3-month version of 615 APR.
Okay, perfect. Thank you.
Sure. So with commodity swaps, it's really quite straightforward. We said it's most often used in the oil and the metals markets, and it protects producers and users. It protects producers against lower prices. It protects users against a higher cost. And in the example that we looked at with the gold example of the South African mining company, we showed that we had a strike price of, or fixed price of $1,800 a troy ounce. We showed that no matter where the spot price went in each period, the producer was protected against lower prices and the user was protected against higher costs by virtue of the commodity swap. And so therefore, both the producer and the user were able to hedge the risk that they anticipated effectively, which means it was a successful hedge. So now we're going to take a look at currency swaps, which are the one swap that we're going to look at, the one swap structure that we're going to look at, where the principal is exchanged at origination and maturity. Okay, so the directions of the cash flows at origination are opposite the directions of the cash flows due to the principal exchange. So at origination, principal is exchanged, and at maturity, principal is exchanged. And then in between, the cash flows follow the swap terms agreement. So a currency swap can be used to change a currency from a fixed to a fixed, fixed for floating, floating for fixed, or floating for floating. And I think the best way to understand this is look at an example. So let's take a look. So here we have a US company that has dollar debt and yen revenue, okay? What's the problem that they have?
If the yen decreases in value compared to the dollar, they have to pay more in debt and they receive less in revenue.
That's a very good answer. Thank you. In addition, the cash flows are clearly mismatched. So I owe in dollars, but I'm earning in yen. And therefore, I'd be better off trying to match up my cash flows with a counterparty that maybe has the exact same problem. So here we have counterparty B, a Japanese company that has dollar revenue and yen debt. So exactly the opposite of the first company. So the mirror problem of the US company. So here we see them plotted out. The US company with its dollar debt and its yen revenue, the Japanese company with its yen debt and its dollar revenue. So both of them face exactly the same foreign exchange risk. And what do they agree to do? They're going to agree to swap debt service payments and create a natural hedge. So here, the US company's yen revenue is going to be used to pay the yen debt of the Japanese company, and the US company's dollar debt is going to be paid with the dollar revenue from the Japanese company. Presuming that the dollar value of the US dollar debt is exactly the same in yen, well, then therefore it's a perfect natural hedge. Yes? And each company can pay the other company's debt service with their revenue. Does everybody understand that?
So the two debts have to be of equal value.
The two
Right.
debts have to be of equal value, which is where the financial intermediary that is taken into consideration the ISM services index that we looked at earlier with economic data coming out today is where you come in with the banks and all the financial intermediaries that make these types of deals possible, because they're going to find us the counterparty. My banker will find me the counterparty, will find me the Japanese company that has dollar revenue that can pay my dollar debt, and I can apply my yen revenue to their yen debt. So the agreement was made, pardon me, to exchange 6% APR, 6% one-year rate, annual rate on yen principal of $1,050,000,000, which at a spot rate of dollar yen 105 is $10 million. So the exchange is 6% on yen principal of $1,050,000,000 against 6% on 10 million every 6 months or every quarter for 3 years. So it's a fix for fixed currency swap. So let's see what that looks like. Again, the settlement's going to be every 6 months, excuse me, not quarterly, every 6 months, beginning 6 months after origination, with the exchange of principal at origination and maturity, as we pointed out, because unlike the other swap structures where there is no exchange of principal, here there is an exchange of principal. It's not so much an exchange of the principal as it is control of the principal. That's an important distinction. So you have the US company, pardon me, that's paying yen through the dealer, Japanese company that's paying dollars through the dealer. So here we are with our two counterparties. At origination, the US company is going to send control of its dollar debt of 10 million to the Japanese company that will then use its dollar revenue to satisfy that debt. At the same time, at origination, the Japanese company is going to send its $1,050,000,000 yen debt or control of it to the US company that will then use its yen revenue subsequently to satisfy the Japanese debt. Now we can plot out the cash flows at maturity also, because we know it's going to be exactly the opposite when the exchange, the swap flows, or the exchange of swap flows is completed, and it's time to return control of the debt to each of the two counterparties. And so in between, though, what do we see? We see that the payments follow the swap contract terms as was laid out before, 6% on the yen principal and 6% on the 10 million. So why is it 31.5 million as opposed to 63 million? And why is it 300,000 as opposed to 600,000? Well, 6% on 10 million is 600,000. Tell me, what's the answer?
Oh, no, it's because it's every 6 months, right?
That's
So it's
right.
not full
Thank
year.
you, Alec. That's fantastic. Beautiful. That's great. Good eye. Good eye. Everybody, I hope everyone sees that. If not, I was going to. You can bring it up now or bring it up later. But Alex put it succinctly and perfectly. It's because there's it's a 6 month settle, and therefore we've got to take a percentage of the annualized rate, the 1 year rate. This is important to keep track of, certainly on a final exam. When you will be asked to plot, you'll be asked to generate some of these cash flows. Let's see what happens, though, in a little bit more of a complicated situation. Here, we're going to look at cash flows for a fixed for floating currency swap. And in this case, the agreement is 6% on yen principal of $1,050,000 like we did before. And now instead of it being 6% on 10 million, it's LIBOR, 1 year LIBOR on 10 million every 6 months. So now we have all the data laid out. All we need to know are the rates. We know that once the principal is exchanged, the subsequent payments, as we said before, follow the swap agreement contract terms with the relevant LIBOR rates exactly as we've laid out up here at the beginning. And here are the relevant LIBOR rates. And therefore, we can plot all the cash flows. right? The question is calculate the per period fixed and floating rate swap cash flows using the period rates cited above. So, pardon me. We can indicate the time from origination through maturity. We know what the LIBOR rates are. Now we know that at origination, there's going to be an exchange of exchange of the control of the debt, or exchange of the debt, if you will. The same thing, we know that the fixed rate payment is going to be the same throughout the term. It's going to be 6% on a semi-annual version of a 6% annualized interest on $1,050 yen, which comes out to 31.5 million yen every 6 months. So we know that for sure. Now the question is how do we calculate the floating rate payment? That's a little bit more complicated. To calculate the floating rate payment, we use the interest rate from the previous period. Yes? So we calculate the floating rate payments using the previous period's closing rate. Okay? So what we do is we take 1/2 of the 550, which is 225, is 275, pardon me, to get 275. I knew something was wrong there. Okay. So that's the quirk of when working with currency swaps. We use the previous period's closing rate. So in other words, when you put on the currency swap, you know exactly what your first payment's going to be based upon the closing rate in the first period when you at origination. So if we follow through for all the subsequent payments, we get 1/2 of 525 yields 262,500 on a notional principal of 10 million, 275 again, 300. So 1/2 of 6 is 3 on 10 million, gets you 300, then 310. Then finally, in the last period, it's 322. And again, at maturity, we see the exchange of debt. We see the exchange of debt, 1,050 yen for 10 million US dollars. And that's it here. Are there any questions on this, how we calculated these cash flows?
Yes, Professor. You said that the 1-year LIBOR is given because I just saw the 6%, and
Say that again, please. Say this
you said
again.
you said that the 1-year LIBOR was given. I just saw the 6.00%.
Right. So the 1-year LIBOR was given. So in other words, in each case, I gave you all these LIBOR rates.
Okay, perfect.
And what you needed to know is that in order to calculate, you had to know that in the first period, you're going to exchange the exchange the sums. Exchange
Yes.
each company is going to hand over control of their debt to the other company. So the US company is going to hand over control of its yen debt, and the Japanese company is going to hand over control of its US dollar debt. And those exchange of cash flows are going to be exactly the opposite at maturity. In between, we know there's one fixed rate payment, and then there's a floating rate payment. Each floating rate payment is based upon the notional principal times the relevant portion of the closing rate from the previous period. So in this period, the previous closing rate was 550. We've got to take 1/2 of that, which is the 275, and multiply that by the 10 million gets us the 275. Do you see that?
Yes, I do.
Okay.
Thank you.
Good. Of course, currency swaps are going to always present greater risk because of the principal exchange. The hope is that nothing untoward goes on, but obviously everyone is obligated contractually, so therefore these are used quite commonly. Okay, let's talk about equity swaps, which is another type of swap structure, but this one is based on 2 legs, which is one is going to be floating and one's going to be based on a market index or a share of stock, for example. It can be based on the Dow or an Apple stock. Equity swaps can be used for two things: for overcoming investment barriers and passing on negative returns. Excuse me. Here again, we have counterparty A and we have counterparty B. Counterparty A is your fixed payer, your floating, or your LIBOR receiver. So they are buying LIBOR. So they're going to pay the S swap spread. Counterparty B, the LIBOR buyer here believes that LIBOR will rise faster than the Dow. Counterparty B is the floating payer, the fixed rate receiver. And the LIBOR seller believes that the Dow will rise faster than LIBOR. So counterparty A is going to pay any percentage increase in the Dow times some notional principal amount, and counterparty B is going to pay LIBOR times some notional principal amount. Now, what happens if the return on the index of the stock is negative? If the return on the index of the stock is negative, then that's called negative flow. And the floating rate receiver is going to receive not only the floating rate payment, but also the negative flow. So that one party is going to be receiving both payments and one party is going to be making both payments. That again, well, not again, just as we saw, there's a quirk with currency swaps in the way that payments are calculated using the previous period's closing rate. This is a quirk with equity swaps, that there is negative flow. So that the party receiving the return on the index here, counterparty B, would be paying the return on the index in the stock when the stock price falls, along with the payment, the LIBOR payment. This is called negative flow. So that if the index of the stock price fall, counterparty A is going to earn LIBOR plus the negative flow payment. So why would a company use such a thing? And why would we in a class like this be concerned about that? Well, let's look at an example. A company that's involved, a multinational company, an oil services company with operations around the world, has 500,000 shares of ExxonMobil, but believes that the stock will generate negative returns in the short run. Well, they could sell the stock, but if they sell the stock, then what do they give up? If there are any dividends on the stock,
Yeah.
pardon me, dividends, what else do they
Yeah.
give up?
Ability to vote, maybe.
Yes, thank you. Because it offers strategic voting rights and the firm doesn't want to lose those voting rights. That's exactly right. Very good, Alec, thank you. So what they can do, the company can hedge its expected negative returns without losing its voting rights by doing what? Well, what they did was they entered into a company with a counterparty, paying a return on its ExxonMobil shares in exchange for LIBOR plus 25 basis points, a notional principal of 10 million. They believe that the return on ExxonMobil shares is going to go down. If they're right, then they're going to get not only the return of LIBOR, but the negative flow from the negative return on the shares. So they're right, they're going to get the LIBOR plus the 25 beeps plus the negative flow. Okay? Any questions?
Yes.
Excuse me, just 1 second. I'm back.
Yes. They can also sell a short-term call options.
Say that again?
I said the company can also sell short.
Can't hear you.
Can you hear me right now?
Can anybody else hear him?
No.
I can't.
Short-term options with equity swaps? Well, sure. Let's talk about using equity swaps to hedge investment barriers. So here we say a company A can invest in company C and then enters into a contract with company B based in country C. Now, company B owns or will acquire the target shares and will exchange shares or returns for a fixed or floating return on the notional principal. So a company isn't allowed to invest in a particular region. Well, they might exchange with a local company a return on the shares for exchange for some type of floating or fixed return on a notional principal amount. So one of the things, maybe Sahar was referring to this, was what we call an equity swap bullet structure. What's a bullet structure? It means there's one payment. So an agreement here was made creating a 6-month equity bullet swap. It's either called an index swap or a bullet swap. You see one exchange of cash flows at maturity. So here, the company believed that Dow would rise faster than LIBOR and agreed to pay LIBOR on 6.95 million principal. Company B held the opposite view and agreed to pay any percentage increase on the Dow in the same period. The question is, LIBOR rates went to 295, one-year LIBOR rates, and the Dow rose 215, 2.15%, 2.15% in 6 months. So what were the swap cash flows? So let's plot it out. We know the floating payment was based on the one-year rate of 295. So we're going to take 1/2 of that because it's 6 months based on the notional principal of 6,950,000 means that the floating payment was 102,513. The fixed payment was based on the Dow increase of 215. Well, it's the full 2.15. It's not a fraction of that. It's the full 2.15. So it was 149,425. So therefore, A receives $46,913. I point out here that if the index had fallen by 215, company A would pay company B the LIBOR plus the negative flow. Are there any questions on that? Okay. Here we have an example where an agreement was made creating a 6-month equity bullet swap, again with one exchange of cash flows at maturity. On a notional principal of 5 million, counterparty A agreed to pay LIBOR and counterparty B any percentage increase on the Dow. So in 6 months, one-year LIBOR was at 597 and the Dow rose 10%. The question was, what are the cash flows? Again, we see the same thing. The floating payment was 1/2 of 597, got us 149,250. And then 10% on the 5 million, which was 10% on the 10% on the fixed increase in the Dow, gave us 500,000. So that meant that counterparty A got 350,750. Okay. Again, if the Dow had fallen by 10%, then company A would have paid B an additional $500,000 due to that negative flow. Okay. Let's talk about credit default swaps, a product that many of you, I'm sure, have heard of. It was pretty notorious during the Great Recession. The belief was, or not the belief, it was said that upwards of 85% of all outstanding credit default swaps, which were considered one of the most toxic instruments fueling the crash of 2008, 9, and 10, along with subprime mortgages, were pure speculation. What does that mean? Well, let's say you're a bank and you have mortgages, right? And you're concerned about the mortgages defaulting. Well, you can take out insurance on that underlying debt because you own the underlying debt. That's a credit default swap. If the mortgagees default, well, then you have insurance on the underlying debt. If you don't own the underlying debt, well, then of course it's just pure speculation. So let's take a look at how credit default swaps work. We know that pricing is based on the probability of a risk-adjusted net present value model, which means what? We've been using the present value formula since the beginning of the semester. You're just, what it's called is bootstrapping. You're looking at all the various cash flows and discounting all the cash flows to come up with the net present value based upon the discounted value of each upcoming payment. We know that banks take credit default swaps against commercial and consumer loan defaults where they own the underlying debt, as the example I just gave illustrated. This was the comment I gave to you. There was an interesting thing I came across just in the last short while about a very interesting trade that was undertaken by a well-known hedge fund here in New York in the beginning of 2020. In the beginning of 2020, the hedge fund traders noticed that junk bonds, junk companies that were low rated. You could buy credit default swaps on low rated companies for the same price you could for more highly rated companies. So therefore, that you were getting credit default swaps on basically high yield debt at a very low price. That was in the beginning of 2020. What happened shortly after? The markets collapsed. And so what the trader reasoned was, well, I can buy cheap credit protection at the beginning of 2020 when things were okay and unemployment was at 3.5%. Because what the trader reasoned was what? That there has to be an arbitrage opportunity, which is what we've been talking about. Because shouldn't it be that high yield debt credit protection should be more expensive than the credit protection that's being charged for solid A companies like Verizon, for example, or LVMH? Doesn't that make sense? Right. So in other words, the spread between the two would obviously widen when the mispricing in the credit default swap market came back into equilibrium. So what happened? We saw the markets collapse in March and April when we began to hemorrhage tens of millions of jobs over a period of months. And what happened to the price of the credit protection for the risky debt during that time?
It got higher, of
It
course.
soared. It soared. It soared. So the guy at the hedge fund trader made a very good bet. He bought cheap credit protection in the beginning of 2020. The markets collapsed. That drove credit protection back into equilibrium, and he booked a huge profit, and his hedge fund is up 70 or 80% for the quarter. So interesting trade that illustrates how credit default swaps can be used speculatively, because of course in this case he didn't own the underlying debt. But I thought it was a good example to bring up. Any questions on that? Okay. So let's say that the pension fund owns the debt of a risky company and takes credit default swaps to hedge its default risk, just the way the bank I mentioned would take out credit default swaps to hedge against the default on its mortgages. So what happens here is that if the company defaults, the pension company will get its money back. If the company doesn't default, well, then the company's yield to maturity is going to be lower because of the premium they paid for the credit default swap, but the risk of loss is eliminated. If the debt of the company improves, right, well, then they can sell the credit protection. So a variety of things that you can do with credit default swaps that are very effective when you own the underlying debt. And in the example I just gave you, it shows how speculators are able to exploit arbitrage opportunities just the way we've seen in the currency markets to book a profit when they do not own the underlying debt. Any questions here? Okay, good. So, sorry about that. Let's talk about amortizing swaps. Amortizing swaps, we see that the notional principal declines over time. Notional principal gets smaller over time. Accreting swaps, the notional principal grows over time. A swaption is merely an option on a swap. So you enter a swaption when you want to have an option to enter into a swap. Have an option on a swap. Okay. One of you asked the other day about what happens when you want to get out of a swap. And so let's talk about the mechanism to do that. So unwinding a swap requires discounting all the remaining cash flows using the risk-adjusted net present value model we just looked at, which is it's the present value model or the present value formula with the terms rearranged. The net present value is the future value, whatever the cash flows are, divided by 1 plus whatever the relevant rate is. We look at that over a series of cash flows. We discount those cash flows back to 0, and that gives us the value of the swap. Another option is that the company can enter into a second equal and opposing swap. So here we have an example where the company's first swap position is they're paying fixed and they're receiving 3-month LIBOR in a fixed for floating interest rate swap. Well, they can enter into a pay 3-month LIBOR, receive fixed, floating for fixed interest rate swap, which is the exact opposite of the first swap position, in order to unwind the first swap.
Don't they pay the trader's fee?
Will you pay a fee? Well, when you pay a fee, when you put on
The
a swap,
dealer's trade.
you pay a fee to put on a second swap position. Sure, you will. Absolutely.
So you're gonna still have a loss of that premium, double premium.
You'd have a double premium. That's right. You'd have the first swap position, and you want to get out of it. So yes, you'd have another premium. It's going to lower your yield to maturity, but to the extent it's going to help you achieve your objective, which is to undo the original swap, well, then you will have achieved your objective at a nominal price.
You got it.
Okay. Okay.
Professor, I have a question. Why
Hey.
would I want to just get out of the swap because of they already paid their
I'm in a
debt?
swap position. I'm in a swap position for 3 years, and my view on interest rates are changed, or the direction of interest rates are changed. I no longer want it to be. I no longer want to be paying fixed. I want to be paying floating. It could be for any number of reasons.
Okay.
Your expectations change, the markets change, interest rates change, currencies change. Something moves to adjust your thinking.
Okay. Thank you.
Okay. I'm going to stop the share for a second and just step out for a second. Be right back. Okay, I'm back. Here's what I'd like to do. I'd like to go back to the screen. Okay. Before we talk about the final, I'd like to talk about a couple of administrative things. I'm going to wrap it up today with swaps. I'm going to post for you tomorrow hedging homework on the material we've done now on swaps, along with some of the other hedging that we've done that's going to help you for the final. I'm gonna post it tomorrow, sometime in the morning when I'm finished with it. I started it just a few days ago, and like I said, I will post it tomorrow morning, and you should work on it along with, I know, all of your other work that I'm sure you're doing, gearing up for finals. But do it over the course of the next number of days, and I'll post the answers for you on Monday. And if you have questions, bring them up in class on Monday. On chapter 11, I'm not going to assign the homework to chapter 11 until Monday. We're going to finish some things on chapter 11 on Monday, and then I'll assign the homework to that. The questions that you're expected to do for chapter 11, which isn't all of them, is listed on the syllabus. It's 1 to 10, and then 12, 14, and 15. But again, you'll see that on the syllabus. I wanted to point out before we talk about the final that 2 important data points are coming out. We have jobless claims on tomorrow, and then we have non-farm payrolls and the unemployment rate on Friday. So very important economic data coming in the next 2 days. We're sure to talk about that on Monday. So again, check tomorrow for homework on hedging homework on swaps. It's important that you take a look at that. Let's talk about the final. The final exam is not cumulative. It's going to include chapters 5, 8, 9, and 11. Okay. Now, if we look here, we've done money market hedging, call and put options, forwards and futures. We've done currency arbitrage, interest rate parity, the Fisher effect, purchasing power parity. We've now gone through all of these swaps in varying degrees of depth, but enough that you have a good sense of them and should be able to calculate cash flows from questions that I'm going to give you on the final. We're going to do non-deliverable forwards. I thought about going into that tonight. I'm going to work on that on Monday with you. It's quite a bit different than swaps, and swaps are enough, I think, for the evening. Non-deliverable forwards are a tool that were developed in the early 1990s to address the proliferation of capital controls around the developed and developing world that, as globalization took off, presented a major problem for multinationals doing business around the world that would be faced with a non-deliverable forward markets and how to deal with that. So we're going to talk about that next week. On Monday, we'll cover interest rate caps and floors. We'll do currency strangles and straddles. We'll talk about factoring, which is a technique that companies can use to raise capital very quickly to address their capital expenditure and other operating costs as they pursue strategies around the world, and techniques called leading, lagging, and finally parallel loans, which we'll finish over the course of the next 3 sessions. And then on the 19th, we'll have our final exam. This is just an initial presentation of my thoughts on the final. I'm sure I'll have more for you next week, but this gives you a basic outline of what we should be looking at for the final exam coming up in just about 10 days. And beyond that, I remain available to all of you over the next number of days. I know that we're breaking a little bit early, but I think that is okay. And hope that you agree with me. I hope that all of you are going to have much success in your last couple of weeks of class with whatever projects you're working on, exams you're preparing for. I want to wish you a good, safe continuation of your evening.